everyone. Very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. Let's tell you what we have lined up on today's episode of The Money Show. First up, today is the 15th of September. It is the last date to pay the second installment of your advance tax. Now, if you're wondering how should you calculate your advance tax, all the more reason why you need to stay tuned over the course of the next 30 minutes, because that's the first topic that we will be talking about on The Money Show. Advance tax, how to calculate, and firstly, even if you're liable to pay advance tax. That's what we have lined up on The Money Show. We will also then be talking about, the all-important notification from SEBI with respect to multi-cap funds, revisiting the conversation we had yesterday with Costa Belapurkar as well as Vishal Chandiramani on their suitability in your portfolio. And later on the show, we'll also be then talking about real estate, because as the festive season approaches, we are seeing a lot of realty developers offering freebies, discounts, tax waivers, GST waivers, among other things. So which ones should you go for? Which ones should you avoid? That's what we'll be discussing, along with, of course, there are all important news with respect to Maharashtra hiking the circle rate. So that's, of course, everything to do with what we have lined up on The Money Show today. Don't forget, in the first segment, of course, you can send in your questions and queries as well with respect to taxation. Our guest will be answering that. And yes, our guest for today, let's welcome him on board the show then. Today we have with us Dr. Suresh Surana, the founder of RSM India. Thank you so much, Mr. Surana, for joining in today on The Money Show. So to start with, let's just first clarify, the government had given some bit of relief from paying advance tax, or at least had cut down the interest or penalty if you can't pay advance tax. What is the status now? I think it's important to first get that out of the way. What is the status now if, let's say, I'm liable to pay advance tax and I don't pay it? What sort of penalty or interest would be imposed on me?
So, first of all, every taxpayer who has a total tax liability exceeding rupees 10,000, he has to pay advance tax in 4 installments, which is 15 June, 15 September, 15 December, and 15th March of the financial year. So, as you rightly said, today is the date for the second installment of the advance tax. In this case, there is one exemption available, that those who are in case of resident individuals and who are more than 60 years of age, so like senior citizens and very senior citizens, they are exempted from paying advance tax unless they have business income. So that is one. Second thing is that those who are having presumptive income, so up to 2 crores of turnover in business and up to 50 lakhs in professional income, you can opt for a presumptive tax regime. So there also you can pay entire amount by 15th March 2021. The rest of the taxpayers, they have to pay the second installment, today. And basically the 15 June first installment, which is 15%, and the second installment put together should be at least 45% of the total tax payable, less, of course, you can reduce, whatever TDS and tax rebate, as well as foreign tax credit, MAT, AMT, etc. So this is why basically this is the applicability as far as the second installment of advance tax is concerned.
Okay, actually, Dr. Surana, I wanted to know about the implications of not paying advance tax. When the lockdown was there, the government, and rather the finance minister, had actually allowed for some leeway. That we understand you're facing a cash crunch, so they had allowed some leeway with respect to advance tax. What I was asking you is that has that leeway now been lifted, or has that lower interest or penalty which you would be charged if you don't pay your advance tax now come back to normal? What's the implication now?
So basically, the interest which is chargeable is 1% per month for the delay. I have not seen, maybe it has just come in, but I have not seen up till now any relaxation on this. So maybe if it has just come in, then I have not checked it. But otherwise, basically on whatever is the advance tax, you have to pay today. You can pay in the bank over the counter, but even if you are not paid, you can make online payment. If you make payment by 8 p.m. today, then it is treated as a payment today. Otherwise, there is no penalty. Of course, one good thing which is there, that even if you don't pay advance tax, there is no penalty, but there is an interest applicable. And even if there is a delay of 1 day, normally there is an interest for the whole quarter, which is then become 3%, which becomes applicable.
Okay, all right. So there is an interest and it's very much there. There's no waiver or anything like that given by the government. And yes, of course, the key criteria is that if your annual tax liability is 10,000 rupees, then you are liable to pay advance tax. Now, Dr. Surana, for a lot of individuals, one may think that, okay, how do I assess my whole year's income, especially when, we are living in such precarious times when there's so much uncertainty. So what would you advise? How should they go about, essentially assessing whether they would be liable to pay advance tax?
I think that's a very good question. There is no doubt that we are living in a lot of uncertainty right now, and particularly even in the job market, where normally you would think that as an employee, there is a reasonable stability. There are a lot of changes happening in terms of the, payroll restructuring as well as job continuity. So, and also the other income, in business and profession, there is no certainty. So I think, as I said earlier, there is no penalty which is applicable. Even if you have, deferred, and you can always make the next installment, which is 15 December. If you pay 75% of the total tax payable in the first 3 installments, you are still okay. And even if you have not done that, by 15th March, you can make the remaining payment. Of course, you will have to pay interest, and hopefully, as you rightly said, if the government does come with some relief on that, because 1% per month for the whole quarter, which means 3%, and that is also not tax deductible. I mean, does become a bit steep. So I think it's a very, I would say, important area where some relief can be given. But I think it is better to be cautious, and you should not overestimate your income. Also, one relief which is there, I must say that at least for the first and second installment, although the total payment up to second installment should be 45%, but no interest is chargeable if you paid 36%, which means up to 20% of shortfall is allowed with no interest. So if you want to, you can even if you pay at least 36%, you will not be subject to interest payment. So I think you have to estimate on a conservative basis, because once you have paid the tax, it is very difficult to, get back refund. Will take a lot of time. So I think definitely, cash is the king today. So you estimate on a reasonable basis and on a conservative basis, I would say, and then pay the tax. This advance tax is applicable not only to individuals, also to HUFs, also partnership firm companies. So all these things. One very important point I would like to share here with you, that the government has come up with an optional, concessional tax regime for individuals now. So the earlier tax regime, you have a choice. Either you go by the old tax regime and claim all the deductions like Section 80C, interest on housing loans, but then the rate and the slabs are higher. Whereas in case of the concessional tax regime, you will not be able to claim these deductions, but you will be having a more liberal tax slab regime. So I think you have to really decide which regime you want to opt for, because you might be able to then reduce your tax liability by going for the regime which is more beneficial to you. Similar thing is there in case of companies, which in fact became operative last year itself. So as you know, the corporate tax rate was reduced to 22% plus surcharge and cess, which is coming to 25%. And but then of course you can't claim certain deductions and all. So again, I think in companies also you can really take a view whether to go for the old tax regime but more concessions, or lower tax regime but with less concessions. So I think this is a very important call people have to make. I think, and that can really optimize again your tax liability.
Yes, when you're calculating your advance tax, actually that will as well have to be considered, that what are the investments you're making, tax saving investments that is, or tax saving expenses. Then for this financial year especially, you'll have to make a decision that how do you want to, or rather what's the tax regime you want to select. Will it be the one that, where you have to pay a higher tax rate, across the slabs, but then you can, claim the benefit of Section 80C, Section 80D, so on and so forth. Or you don't want to claim these benefits, and you want to pay a lower tax rate. So it will require you to do all of these calculations. So get that pen and paper out and start doing it right away, because like Dr. Surana mentioned, you have till 8 p.m. today to make the payment of advance tax. Dr. Surana, I think you did mention this in your first answer, but just for the benefit of our viewers, a lot of our individuals are salaried, or they have some interest, that has been earned on bank fixed deposits, etc. Basically, many of the payments do come after deducting TDS. Especially for, of course, salaried individuals. When I am making my advance tax payment, which is, 45% of my full year's liability, should I deduct the TDS and then make the payment? Just want to get that checked, clarified once again.
Is being deducted or is going to be deducted for the whole year, you have to estimate that will be deducted. Similarly, tax rebate also, which is available, you can deduct that. And in case you are having any overseas income, then foreign tax credit also, you are eligible for credit in India, you can deduct that. If you are in alternative minimum tax or MAT regime in case of companies, and in case of non-corporate AMT, if you have that credit, you can also deduct. So after deducting all those things, only you need to really compute your advance tax payable. And basically, there is absolutely no doubt that you can claim all those things and don't end up paying excess tax on that account. And one more thing, as we talked about, that even you may not go for 45%, you may pay even 36% or slightly more than that, so that you can still conserve your cash and see how the year turns out for you. One other important point I think here we must mention, that the TDS rates have been lowered in May 2020 by the government by 25%. So for example, if earlier there was a 10% TDS or interest or rental payments, it has reduced to 7.5%. But the tax rates have not been reduced for the overall tax liability. So you might have a higher tax liability because whatever TDS is being deducted is on the lower side right now. Similarly, dividends also, which were till last year only taxable if it was more than 10 lakh rupees, and that also at the rate of 10%. 1st April 2020, the dividend distribution tax has been abolished, and now the dividend is taxable in the hands of shareholders. So whatever dividends you are getting, it will be taxable at the normal rate, and there will be a TDS on dividend. So you have to consider both the income and the TDS, and then also calculate your advance tax liability, because TDS normally would be at a much lower rate. So you will again might have to end up paying more advance tax on that account as well.
Basically, Dr. Surana, this year is going to be very different. The 15 June advance tax as well had a lot of changes. 15 September as well, lots of changes. 1, 2 tax regimes. The second, of course, is the lower TDS deduction, which again the government did allow. And then, of course, thirdly, there's also the whole bit with respect to just in general, the COVID related issues that all of us have been facing, which has also made it difficult for all of us. And then, of course, not to mention the dividend, which all this while was not taxable, but now DDT is abolished, which means dividend will have to be added to your total income as well. And if the company has as well deducted TDS on your dividend, then that too can be considered as a credit, to your total tax bill. Dr. Surana, you were mentioning about how 36% can be paid before the 15th of September. So which one is it, 45 or 36? And I'm sure given an option, people would like to pay the 36% of the total tax liability. So when is which amount applicable?
You don't have to pay interest for deferment. So for example, although you are required to pay 45%, but if you have paid 36% and then make up for the shortfall subsequently, you will not have to pay interest for the shortfall. So therefore, effectively, you can defer it to the next installment. And that is only applicable for the first 2 installments. And also partially, maybe it is recognizing, earlier the point which you alluded to, that because at the beginning of the year and particularly this year, there is a lot of uncertainty. So first 2 installments, government has recognized that probably you may not be able to estimate accurately. So as long as you have paid 80% of the normal, what you should have paid. So 80% of 45% is 36%. Then they will not charge you interest for the shortfall. So I think right now, as we talked about earlier, if you pay slightly more than 36%, then you should be, you should be okay. You conserve the cash, see how the year goes by, and always you can make up for the shortfall later. And there is no penalty in any case.
All right. Okay. Now, Dr. Surana, with so many changes, etc., happening, I'm sure a lot of our viewers are a little, they're fumbling right now that, okay, I just have roughly about 2 hours to go to make my advance tax payments and I don't know where to start off. So what would be one simple tip that you would, give them to ensure that they do not have to pay that, that interest that comes about for non-payment of advance tax? What would you recommend they do? Since we just have a couple of hours to go.
We are already, 5 p.m. So I think it may not be feasible unless the bank branches are open to make payment through the bank branches. There is an online payment available. So if you go to www.tin-nsdl.com, you are allowed to make online payment. There is a challan in the form ITNS 280. So basically, you can use the online payment facility and ensure. And if you make payment by 8 p.m., you will not be. It will be counted as payment today. You will not be liable to pay interest. Of course, unless the government comes up with some extension or relief, then it's a different thing. So I think definitely one should look at that very quickly. Look at your tax liability. Look at the alternative tax regime, and if you think that you are liable to pay, then at least pay 36%. I think this will be my quick, tip to you.
Dr. Surana, just a question on Form 26AS. Much has been said about how it's going to come in its new avatar in this financial year, much more comprehensive than what it has been in the past few years. In fact, I believe all I'll need is the Form 26AS. If I'm just a simple salaried individual, all I need is the Form 26AS and I'm good to go when it comes to filing my return. Do you think accessing a form, firstly, is it possible to access a Form 26AS in the middle of the year? And secondly, do you think that will also ease the process of, quickly assessing what your advance tax liability is and to pay it off?
Yeah, I think it is very important because going forward, as you know, even with the announcement of the faceless, assessment and e-assessments happening, I think more and more it will be, the assessments will be data driven. And of course, one of the most important sources the government has is information available on 26AS. Not only various, what kind of incomes you are having and the tax reduction on those and the investments, what you are making. So basically, I think it is a good self-check to make sure that you have reviewed, 26AS and wherever, suppose you, for example, somewhere tax is deducted and credit is not being reflected, you can approach those parties so that you get full credit. So I think it is a very good, I would say, self-evaluation check to ensure A, that you get full credit, and B, that you have not missed out something which will be picked up later by the authorities, which might then result in a scrutiny assessment or, more questions being asked. So I think it's a very valid, point, and I think it is more and more going to become important as we move away from physical assessments into data-driven assessments.
Right. Well, there you have it, everything that you need to know about your advance tax. Remember, folks, that you will have to essentially firstly check that your tax liability for the year is going to be more than 10,000. If yes, you need to ensure that you pay 45% of your year's tax liability by today. So let's assume that my tax liability for the year is 10,000 rupees. I'm going to try and ensure that at least 4,500 rupees is paid by today. In fact, before 8 p.m. Thankfully, it's all online, so I can simply log on and make an online payment. If you don't know where to start off, well, maybe a 26AS could be a good step, but largely, if you're a salaried person, the process is pretty simple. Firstly, in all probability, your company itself will have deducted quite a bit of TDS. So first take a look at how much TDS has been deducted by your company. There is a possibility that you may not have to pay any advance tax if your company itself has already deducted that much TDS, because that too is a form of advance tax. Okay, well, folks, if you have any taxation related questions, queries that you would like Dr. Suresh Surana to answer, you can always email us on themoneyshow@etnow.tv. That's themoneyshow@etnow.tv, and we will get it answered right away. So for now, let's take on board some questions we've already received. We have R. Ashar who is writing to us, a very interesting one. He says, are NRIs allowed under FEMA, which is the Foreign Exchange Management Act, and the income tax rules to form a family discretionary trust of NRI status? And is registration of such trust mandatory? And how do TDS rules apply to such, a trust which has NRI status? Dr. Surana, how would you guide R. Ashar?
First of all, anyway, taxation of trust is a very complex subject, and we are talking about FEMA and tax, but I'll try and keep it as simple as possible. So first of all, as there are many Indians who live abroad, and there's some family members are in India or outside India, and they want to create trust. So an NRI, if he wants to create a trust outside India, there is absolutely no FEMA issue in which he can have non-resident beneficiaries as well as Indian residents also as beneficiaries. There is absolutely no FEMA issue on that and no tax issue on that. The only thing is that in case any Indian resident is a trustee or a beneficiary of the overseas trust, then he has to make a declaration while filing his tax return in India. So in India, when you file your tax return, there is a schedule called Schedule FA, which is basically foreign assets. In that he has to disclose if he is a beneficiary or a trustee of such a trust. The other important thing is that a foreign trust, if it is wholly controlled and managed outside India, then it will not be liable to tax in India. So assuming that the trustees are outside, settler is outside, and the beneficiary, even if there is a resident beneficiary, but if he is not exercising any control management, then such trust would not be taxed in India. If the resident beneficiary receives any distribution in India, then such distribution of income will be subject to tax in India. As far as Indian laws are concerned, you don't require any registration of the overseas trust, and again, it depends on jurisdiction where you are setting up the trust. In that case, the law of that country, if it requires registration, then registration will be required. So coming to the second part, which is probably more complex, that if a non-resident wants to settle a trust in India, he can do that. If he wants to settle a trust in India with the resident beneficiaries, there is no issue at all. A private family discretionary trust is created under the Indian Trust Act 1882, which is a very old law. It does not require any registration, but normally you would execute a written deed between the settler and the trustees, which will specify the beneficiaries and the distribution and powers of the trustees, etc., etc. So basically, such a trust normally, if it is an Indian trust and if it has non-resident beneficiaries again, then the settlement and any distribution of income to them would be subject to the FEMA regulations. Now, also mind you, there is no specific FEMA regulation dealing with the trustees and beneficiaries. Most of the aspects in FEMA, like foreign investment or overseas investment, ECBs are all covered by FEMA regulation, but the trust has not been covered by any regulation specifically. So you need to be a little conservative, and if you can approach RBI for clarification or for approval if you are in doubt at any stage. Normally, an Indian trust would have income in India and also would be controlled, managed at least partially in India. So it would be subject to tax in India. And the taxation is not very friendly, because even if one beneficiary out of all the beneficiaries is having taxable income, then the trust is taxed at the maximum marginal rate, which is 42.7%. So it is a very steep taxation which becomes applicable. There is no basic exemption or slab wise. It is taxed at a flat rate, except of course the capital gains and dividend income, which are taxed at a lower rate. So essentially, you have to be very clear about your objective when you are setting up a Indian trust, unless obviously it is achieving larger objective, and as a non-resident, one has to be additionally careful. That is what I would suggest.
Right. Okay. Well, unfortunately, we just have time for one last query. It's yet again from another NRI. Looks like we have an NRI special today. Sudesh Nair says that I earn interest on my FDs in my NRO account, which basically is a special kind of deposit account that NRIs can open in India. But he says that he also earns dividends from his portfolio of Indian shares. Now, in light of the DTA, could you please advise on my tax implications in Australia on these two sources of Indian income? That's interest on NRO accounts and dividend from, again, Indian shares. Dr. Surana, would there be any tax in Australia perhaps, and what about the tax incidence in India on these two sources of income?
So I think this is a very common, we have, more than, I think almost basically 20 million NRIs all over the world, and a lot of them invest into India. NRE and FCNR deposit interest is exempt from tax. But NRO deposit, which is non-resident ordinary account, deposit is taxable in India. If the deposit is made out of convertible foreign exchange, which means the person has remitted the money from abroad and then he has invested, then there is a lower tax rate of 20% applicable under the normal provisions of Income Tax Act. If the person was already having money in India, for example, before leaving India, or it is not out of convertible foreign exchange, then the normal tax rates are applicable, which, as you know, can go as high as 42.7%. But fortunately, we have a double taxation avoidance agreement with Australia, and any interest payment from India, if it is paid to an Australian tax resident, and I assume that in this case, the gentleman is an Australian tax resident, then he can claim the lower tax rate of 15% in India. And then in Australia also, he will be able to claim credit for this Indian tax against his Australian tax liability. So that is as far as the interest on NRO deposit is concerned. As far as dividends are concerned, I think this is, as we earlier also spoke about, that from this 1st April 2020, dividends have become taxable. So even for NRIs, there is a 20% TDS on the dividend payment. Again, fortunately, under the treaty with Australia and India, there is a lower rate of 15% applicable. And so he can definitely claim. He should have a tax residency certificate of Australian tax authorities and give it to the Indian company which is declaring dividend. And he will be able to claim credit for the same in Australia. So I think to that extent, he will be not having a double taxation. And that is the whole purpose of the double taxation avoidance agreement.
Okay, Dr. Surana, thank you so much for joining us then today to so briefly explaining down the entire advanced tax bit for all of our viewers and of course answering all their questions and queries as well. We will take a very short break right here on the show. Don't go anywhere.